Welcome to Property Report UK, your trusted source for independent analysis and the latest updates on the British housing market. Today, we're examining a developing story that's rippling through towns, cities, and entire regions across the country. Beneath the surface of what many call a cooling market, something far more significant is unfolding: a slow, structural correction that's reshaping the future of property ownership in Britain. This is not just about prices. It's about pressure on homeowners, landlords, developers, and even the idea of home ownership itself. Let's begin in the heart of England, in the small town of Cudden, where a single sale tells a much larger story. A house in Cudden has just sold for £190,000. 3 years ago, that same property fetched over £300,000. The seller was desperate, the buyer a cash investor. And that small example is now being mirrored across much of the United Kingdom. From the southeast to the Midlands, even into parts of Wales, homeowners are quietly panicking. The headlines might describe a slight slowdown or a market adjustment. But on the ground, what's actually happening is more serious. Because while the surface appears calm, the foundation is beginning to crack. Over the next 18 months, more than 1 million UK households are due to roll off their fixed-rate mortgage deals. For many, those rates were locked in at 2 to 3%, back in the years when borrowing was cheap and money was flowing freely. Now, as those deals expire, new offers are coming in at 5 or even 6%, and the numbers don't lie. Let's take a typical example. A £250,000 mortgage at 2% would have cost around £1,100 per month. At 6%, that same loan jumps to roughly £1,600 per month, an extra £500 every month, or over £6,000 a year simply disappearing. For families already stretched thin by rising grocery costs, record energy bills, and childcare expenses, that jump isn't just inconvenient, it's transformational. And what makes it particularly challenging is the timing. The financial strain doesn't hit all at once. It arrives in waves. Each month, thousands more households reach the end of their fixed-rate deals and suddenly find their monthly budgets no longer add up. This slow-motion financial shock is one of the clearest signals that the UK property market has entered a new phase, one where affordability, not aspiration, is in charge. But it isn't only homeowners feeling the squeeze. Landlords, once the quiet winners of Britain's housing story, are also facing a reckoning. After years of capital growth and steady rental yields, the economics of buy-to-let are deteriorating. Mortgage rates have surged, regulations have tightened, and the tax advantages that once made property investments so appealing are being steadily dismantled. Let's look at the numbers again. A landlord with a £200,000 buy-to-let mortgage would have paid roughly £650 per month back in 2021. Today, that same loan costs around £1,100. Meanwhile, the local rent for that property may only be £1,200. After taxes, insurance, maintenance, and occasional void periods, many landlords are barely breaking even. Now, add the upcoming abolition of Section 21, which removes the ability to evict tenants without cause. For many small or accidental landlords, that change fundamentally alters the risk calculation. It's no surprise that more are choosing to sell. According to recent figures, 19% of landlords sold at least one property last year, while only 8% purchased another. That's a clear net reduction in rental stock. And when rental supply drops, rents rise, which is exactly what we're seeing now. But here's the paradox: as landlords exit, more homes are listed for sale. That increases supply in the sales market, pushing house prices down, even as rents continue to climb. The system is moving in opposite directions, and that imbalance is creating volatility unlike anything we've seen since the financial crisis. For decades, London's luxury property sector was powered by international money. Russian oligarchs, Middle Eastern buyers, Chinese investors, they all poured billions into prime postcodes, often paying in full before the foundations were even laid. Developers relied on this global demand, using it to fund entire projects. Local councils tolerated it, because that foreign capital kept the construction cranes moving. But that era is fading fast. Post-Brexit uncertainty, global sanctions, currency fluctuations, and new taxes have dramatically reduced overseas appetite for UK property. The additional 2% stamp duty surcharge for non-UK residents, combined with broader geopolitical pressures, has made British real estate a tougher sell. In 2023 alone, foreign investment in UK property fell by more than 40%. And this exodus has had an immediate effect on the high-end market. Luxury flats in Canary Wharf, Nine Elms, and Kensington that once sold out before completion are now sitting empty. Developers, unable to attract the usual international buyers, are offering discounts of up to 20% just to move inventory. But when the top end of the market softens, it sends ripples down the chain. Because if a developer can't sell a £2 million penthouse, the value of the £800,000 flat below it starts to fall, too. And as those prices adjust, the stability of the broader market begins to wobble. This shift has revealed an uncomfortable truth: the UK hasn't been building homes for people. It's been building assets for investors. From glass towers in London to small developments in commuter towns, the system was designed to attract capital, not create affordability. Now, with foreign buyers pulling out and domestic investors retreating, those foundations are showing cracks. Many new-build flats are sitting empty not because no one wants to live in them, but because no one can afford to. The result? A growing mismatch between what's being built and what people actually need. We're seeing ghost developments, pristine, high-spec apartments without residents alongside families crammed into outdated rentals that were never meant to handle modern demand. It's a quiet, structural failure that's slowly reshaping Britain's housing map. But perhaps the most profound change isn't economic at all, it's psychological. For decades, home ownership in Britain was seen as a rite of passage: get a job, save a deposit, buy a house, build a life. Today, that dream is slipping away for millions. Nearly half of renters under 35 now believe they'll never own a home. Not because they don't want to, but because the math simply doesn't work. A modest one-bedroom flat in Hackney can cost £450,000. Even with a 10% deposit, monthly mortgage payments easily exceed £2,000 more than most people earn after tax. Older generations often point out that interest rates were higher in the 1980s. That's true, but house prices were far lower. In 1985, the average UK home cost around £40,000. Today, it's closer to £380,000. So while the percentage rates might look similar, the scale of debt is incomparable. This reality is forcing lifestyle changes across the country, from co-living and multi-generational households to young professionals emigrating altogether. The cultural belief in home ownership as a guaranteed life goal is breaking down, and that could have lasting consequences for the UK economy. This isn't just a housing crisis, it's a wealth crisis. More than 60% of UK homeowners are now over 50, holding hundreds of thousands of pounds in equity. Meanwhile, younger generations are locked out paying record rents, with no path to ownership and no stake in the wealth they helped create. The divide isn't only financial, it's generational, and it's widening. Older homeowners, sitting in properties that have quadrupled in value, often occupy homes larger than they need. Younger renters, by contrast, are spending half their income to live in spaces half the size. And yet, both groups depend on the same housing system. When new buyers stop entering the market, the chain of demand weakens from the bottom up. That, in turn, puts pressure on prices at every level. Because property values are only as strong as the number of people willing and able to buy. On paper, national averages suggest a modest dip in prices, a few percentage points here or there. But averages hide the truth. Across large parts of England, transaction volumes are down by 30% or more year on year. That means people aren't buying, but they're not selling either. It's a standoff. Buyers are waiting for prices to fall further. Sellers are clinging to valuations from 2 years ago. And estate agents, caught in the middle, are finding it harder to close deals. This stalemate creates the illusion of stability, but in reality, it's a sign of deep freeze. The market isn't correcting quickly, it's grinding to a halt. And that's what makes the current moment so precarious. Because when prices fall slowly, people don't feel the impact until they do. Experts are warning that Britain may already be in the early stages of a silent housing correction. Not a dramatic crash, but a drawn-out revaluation of what property is really worth in an era of higher interest rates and lower investor demand. The signs are everywhere: falling prices, rising rents, and transactions stalling. For most, it doesn't feel like a crash yet, but the financial and psychological shifts underway could prove even more transformative. Because every correction also creates opportunity for those paying attention. If you're a buyer, the key is patience. Focus on value, not velocity. If you're a seller, understand your position and be realistic: the market has changed. And if you're a renter, keep your costs lean, watch local trends, and prepare for further volatility. The housing market is recalibrating, and this process will take time. But history shows that from every correction comes a reset and often, a chance to rebuild on stronger, fairer ground. This has been Property Report UK, providing clear, unbiased insights into the housing market's biggest shifts and what they mean for you. If you found today's report helpful, make sure to subscribe, like, and turn on notifications so you never miss a property update. We'll continue tracking the trends shaping Britain's housing future, from mortgage shocks and policy changes to regional price movements and rental dynamics. Thanks for watching. Stay informed, stay prepared, and as always, stay tuned to Property Report UK.